The parent company behind Ram, Dodge, and Chrysler just went nuclear, announcing a jaw-dropping 35% cut on MSRP across key models. You heard that right, 35% off brand new trucks, muscle cars, and family vehicles. This isn't just a discount, it's an earthquake shaking the entire US car market to its core. Ford and Chevy executives are reportedly in full panic mode, and dealerships across the country are scrambling to figure out what just happened, because this isn't a seasonal sale or a limited time rebate. This is a full-blown price war. Let's start with the breaking story. Stellantis' move comes out of nowhere. At a time when nearly every automaker is raising prices, not cutting them, average new vehicle prices in the US are still hovering near record highs, and consumer demand is falling off a cliff. So why would Stellantis voluntarily slash profit margins on some of its best-selling vehicles, like the Ram 1500, Dodge Charger, and Chrysler Pacifica? Insiders say this is part of a massive strategy shift, one that could change the way Americans buy cars forever. Here's what's really going on behind the scenes. Stellantis has been quietly building inventory for months. With demand softening and dealer lots overflowing, the company faced a hard choice: either cut production and risk slowing down its factories, or slash prices to move metal fast. And Stellantis chose chaos. By taking 35% off MSRP, they're not just trying to clear inventory, they're sending a message to Ford, GM, and Toyota. You've been overcharging customers for too long, we're breaking the cycle. And make no mistake, this isn't just a sales tactic, this is a declaration of war in the pickup truck and muscle car markets. A Ram 1500 that was once stickered at $58,000 could now drop to under $38,000, depending on trim and incentives. That's cheaper than many used trucks sitting on dealer lots right now. Used truck dealers are already furious, calling this move market suicide because it completely wrecks used vehicle values overnight. Imagine buying a 2022 Ram for $45,000, only to see brand new 2025 models listed for thousands less. The used market just got obliterated. But here's where it gets even more interesting. Industry analysts believe Stellantis is playing a long game here. Some say this aggressive pricing isn't just about moving gas-powered models. It's about clearing space for what's coming next. A full-scale EV transition. Stellantis has already teased upcoming all-electric versions of the Ram 1500 Rev, the Dodge Charger Daytona, and new hybrid variants under Chrysler. Slashing prices now could be their way of liquidating ICE inventory before a major EV wave hits dealerships in 2026. And that's not the only angle. Some insiders suggest this is Stellantis' counterattack against Ford's and GM's EV losses. While competitors have been bleeding billions trying to electrify their lineups, Stellantis is making a power move, doubling down on affordability, brand loyalty, and market share. It's almost like they're saying, you can keep your $80,000 electric trucks. We'll sell real trucks people can actually afford. And honestly, consumers are listening. Buyers are rushing to dealerships across the country, desperate to lock in deals before inventory disappears. Reports are already surfacing that some dealers are fighting back, refusing to honor full discounts or adding hidden fees to offset the cuts. But customers are catching on fast, walking out and hunting for dealers willing to play fair. For shoppers who've been priced out of the new car market for years, this is the moment they've been waiting for. Brand new trucks and cars at prices we haven't seen since 2017. Meanwhile, automakers like Ford and GM are under massive pressure to respond. If Ram can afford to chop prices by a third, what's stopping the competition? Will we see a domino effect with Chevy slashing Silverado prices next, or Ford cutting F-150 MSRPs to stay relevant? Because if they don't, Stellantis could single-handedly reset consumer expectations for what a truck or muscle car should cost. And here's where the ripple effect starts to hit the broader economy. This 35% price cut could send shockwaves through the entire used car market, collapsing resale values and forcing dealers to reprice thousands of vehicles overnight. Lenders, leaseholders, and even rental car companies could be affected as the value of their fleets drops. We're talking about a potential industry-wide correction sparked by one bold move. But beneath the chaos, Stellantis' CEO Carlos Tavares might have a master plan. Tavares has long criticized other automakers for pushing unaffordable EVs and inflating prices. By repositioning Stellantis as the value brand powerhouse, offering power, performance, and tech at unbeatable prices, he might be preparing to dominate both the ICE and hybrid markets before fully diving into EVs. It's a classic underdog playbook move. Win the middle market, take share from the giants, and set the stage for the next era of mobility. Consumers, however, are divided. Some Ram and Dodge owners are furious that their vehicles just lost thousands in value overnight. Others are ecstatic, finally seeing automaker greed being challenged head-on. Social media is exploding with posts from buyers sharing unbelievable deals. Just got a brand new Ram 1500 for less than a used Tacoma. Dodge Challenger GT for under $30K. This is insane. But the question remains, how long can Stellantis keep this up? Can they actually sustain profit margins after slicing off 35%? Or is this just a short-term shock designed to dominate headlines and clear space for something even bigger? Because if Stellantis proves this model works, selling high-quality vehicles at reasonable prices, it could trigger a massive realignment of the global auto market. And that's not all. Whispers are already circulating that Stellantis may use this momentum to restructure dealer relationships entirely, cutting out middlemen and pushing more direct-to-consumer sales models similar to Tesla. If true, this could be the first step toward a complete revolution in how cars are sold in America. Imagine walking into a Stellantis online store, configuring your Ram 1500 or Dodge Charger, and ordering it directly from the factory. No haggling, no dealer markups, no games. That's the direction Stellantis has been hinting at for years. This 35% price cut might not just be a financial move. It could be a test run for a new business model where the company controls pricing, marketing, and customer relationships from start to finish. If that happens, dealerships as we know them might be in serious trouble. Already, some are calling Stellantis' move a betrayal, saying corporate just undercut their entire pricing structure. Think about it. These dealers ordered inventory months ago at higher costs, expecting to sell Rams and Chargers at premium prices. Now, overnight, their profit margins are wiped out, and buyers are demanding to pay 35% less. Some dealers are even threatening to boycott Stellantis shipments unless the manufacturer offers rebates to cover their losses. But Stellantis doesn't seem to care. They've gone all in, and they're willing to burn the old system to build a new one. And this isn't happening in isolation. We're seeing a broader shift across the auto landscape. Consumers are fed up with inflated prices, sneaky markups, and interest rates that make car loans feel like mortgages. Stellantis might have just cracked the code. Instead of fighting the market, they're embracing affordability as their new brand identity. When every other automaker is chasing luxury margins and six-figure EVs, Stellantis is saying, let's give the people cars they can actually buy. Now, here's where the shockwaves get even bigger. Analysts say this 35% cut could force the entire truck market into a deflation spiral. Used truck prices, already softening from pandemic highs, could fall another 20% or more as buyers flee the secondhand market for brand new discounted models. Banks and lenders are watching nervously, knowing that the collateral value of truck loans could collapse. And if that happens, we could see repossessions rise and lease values plummet, all because Stellantis just detonated a pricing bomb across the industry. But here's something few people are talking about. Stellantis might not even be losing money on these price cuts. Insiders point out that the company has some of the lowest production costs per vehicle among global automakers. By manufacturing at scale in North America and leveraging global supply chains, Stellantis could be using sheer efficiency as a weapon. If they can build a Ram cheaper than Ford can build an F-150, and still profit at 35% less MSRP, then Ford and GM are in deep trouble. This is pure competitive warfare, and Stellantis might just have the upper hand. Meanwhile, Dodge is using this opportunity to reignite its performance legacy. With gas-powered Chargers and Challengers nearing their end before the EV transition, the company wants to go out with a bang, literally. Expect to see massive discounts on Scat Packs, Hellcats, and Durangos as Stellantis clears the decks for the upcoming electric muscle car lineup. Imagine picking up a 707 horsepower Hellcat for the price of a mid-tier SUV. It sounds crazy, but that's exactly what's starting to happen. And Chrysler, often seen as Stellantis' quiet brand, is finally stepping back into the spotlight. With Pacifica minivans and hybrid models getting deep discounts, Stellantis is signaling that family buyers matter again. They're not just chasing truck enthusiasts or muscle car fans, they're going after everyday Americans who've been priced out of the new car market. This could completely reshape Chrysler's image from forgotten to affordable and reliable. But what's even more shocking is how quickly this is spreading online. TikTok, YouTube, and Reddit are flooded with posts from people sharing dealership screenshots, invoice breakdowns, and before and after prices. One viral clip shows a buyer driving home a Ram Laramie for under $40,000, shouting, "This is cheaper than a used Tacoma." The internet is exploding with disbelief, and that's exactly what Stellantis wants. They're not just selling cars, they're selling a narrative that Stellantis is the hero fighting back against corporate greed. Now, Ford and GM are in a tight spot. Do they fight back with discounts of their own and risk triggering an industry-wide price collapse? Or do they hold the line and watch Stellantis steal their customers? Either option is dangerous. If Ford drops F-150 prices to match Ram's, their profit margins could vanish. If they don't, Ram could dominate the truck market in 2025, becoming the go-to brand for buyers looking for value and power. And behind the scenes, something even more fascinating is happening. European and Chinese automakers are watching this experiment very closely. If Stellantis pulls this off, cutting prices while maintaining profitability, expect global brands like BYD, MG, and Geely to adopt similar strategies when they expand into the US market. The US auto industry could be on the verge of a full-scale price revolution, where value finally replaces hype. But here's the twist. This could also be Stellantis' warning shot before a total EV and hybrid restructuring. Reports suggest that by mid-2026, Stellantis plans to phase out several gas-powered trims and pivot toward new plug-in hybrids and full EVs built on its STLA platforms. This massive 35% discount blitz might be the final blowout before the next generation arrives. Think of it as Stellantis saying, "Let's sell every gas model we've got and make room for the future." And that brings us to the big question. What happens next? Because if Stellantis can prove that affordability sells, it could force the entire market to recalibrate. Luxury EVs might struggle, used car values could keep falling, consumers might finally regain power in the car buying process, and legacy automakers, from Ford to Toyota, might be forced to rethink everything from pricing to production to the dealership model itself. But we're only seeing the beginning of this story. Stellantis' 35% price cut isn't just a marketing stunt, it's the start of a market rebellion that could reshape the American auto industry for years to come. Think about what this means on a deeper level. For decades, automakers have trained consumers to expect higher prices, limited supply, and endless markups. Every new model year was another excuse to push prices higher, even as wages lagged behind. But Stellantis just shattered that illusion. They've effectively said, cars don't have to cost this much. And that's a message millions of Americans have been waiting to hear. Now the floodgates are opening. Buyers who've been sitting on the sidelines, frustrated with outrageous prices and sky-high interest rates, are diving back into the market. Financing companies are already reporting surges in new applications for Stellantis models, especially the Ram 1500 and Dodge Durango. Leasing options, which had all but disappeared during the pandemic price boom, are suddenly coming back, making it even easier for average buyers to get behind the wheel of a new car again. But not everyone is celebrating. Behind closed doors, competitors are panicking. Ford, GM, and even Toyota executives are reportedly holding emergency meetings, trying to decide whether to match Stellantis' cuts or ride out the storm. The problem is, they don't have much room to maneuver. Their supply chains are still expensive, their dealer networks are bloated, and their EV investments are bleeding cash. Stellantis just exposed a harsh truth. Most automakers have been relying on inflated prices to stay profitable. Now that illusion is cracking. Industry analysts are calling this the Stellantis shockwave. They say it could be the beginning of a deflation era in car prices, something we haven't seen in decades. If new vehicle prices keep dropping, used car values will follow, and the entire financing structure of the industry could unravel. That's how disruptive this move is. One company decided to flip the table, and now the whole industry is scrambling to catch the pieces before they hit the floor. And let's not forget, Stellantis has the product strength to back this up. The Ram 1500 is already one of the most refined trucks on the market, with premium interiors and top-tier towing capabilities. The Dodge Charger and Challenger, even in their twilight years, still have massive fan bases and unmatched performance at their price point. And Chrysler, often underestimated, has quietly built one of the most advanced hybrid minivans in America. So when Stellantis says, "We're cutting prices," they're not discounting junk, they're slashing prices on vehicles that people actually want. Now, here's something that's sending shockwaves through Wall Street. Stellantis stock has been quietly surging while other automakers struggle. Investors are starting to realize that Stellantis' global diversification, with massive profits from its Jeep, Peugeot, and Citroën brands overseas, gives it more flexibility to play offense in the US market. They can afford to take hits here because they're winning elsewhere. That's a strategic advantage Ford and GM just don't have right now. And let's be honest, this couldn't have come at a worse time for them. Ford is still reeling from billions in EV losses, supply issues, and union costs. GM is facing backlash for its delayed EV rollouts and scaling back on production targets. Meanwhile, Stellantis is quietly executing one of the boldest price plays in modern auto history, stealing headlines, market share, and consumer goodwill all at once. But here's where the plot thickens. Stellantis isn't just trying to sell cars, they're trying to rebuild trust. After years of frustration with dealership games, inflated MSRPs, and sneaky market adjustments, consumers are finally seeing a brand that's fighting on their side. The reaction online has been explosive. Thousands of comments saying things like, "Finally, an automaker that gets it," and "I'll never buy from Ford again. Stellantis just earned my money." That kind of grassroots momentum is priceless. Still, not everyone is convinced this will last. Some experts warn that these price cuts could backfire if Stellantis can't maintain margins long term. The company might be betting on volume over profit, hoping that massive sales will offset thinner margins. If it works, Stellantis could rewrite the playbook on car pricing. If it doesn't, it could trigger a race to the bottom, where every automaker slashes prices just to survive. Either way, the industry is never going back to normal, and that's exactly why this moment feels so historic. We might be witnessing the end of the inflated car era. For years, automakers used supply shortages, chip crises, and fake scarcity to justify sky-high prices. But now, Stellantis just shattered the illusion, proving that they can still build and sell great cars without ripping off their customers. It's a wake-up call, and every brand from Ford to Tesla is paying attention. Because here's the wild part. Some insiders believe this move could even pressure EV pricing across the board. If Stellantis can offer powerful full-size trucks and muscle cars for under $40,000, it'll be hard for companies like Ford and Rivian to keep selling electric pickups at nearly double that price. We could be on the verge of a massive EV affordability war where automakers are forced to rethink how they price their future models.